In 2012, the US government had $16 trillion in national debt, and today it's $32 trillion. That is a doubling in the last 10, 11 years. And a lot of that came since COVID because we had to bail out a lot of people. So what does that mean for the future of the US? Remember, when you borrow money, you're taking away from the future. Whether you do that personally, whether a company does it, you're taking money today to pay off an obligation some point down the road, right, Mo?
Yep.
So, like if you pay cash, and I'm not condoning this, but if you pay cash for your house, it gives you more cash flow in the future. But you're taking away from today. If you borrow money, you're getting more today, but you're sacrificing the future. But debt isn't a bad thing. I don't believe debt's a bad thing. But the question is too much debt a bad thing? I think we'd all agree that too much of anything is probably a bad thing, right?
Correct.
And bubbles occur when a very reasonable idea comes to market and then it's exaggerated, right? Real estate is a great investment and then it became a bubble. Stocks are a great investment. We think we're in a bubble. All these things happen over time. So on this channel, what I'm trying to do is show you guys the data that I see, give you guys my opinion on it, but also help you guys realize that there are going to be ups and downs in our economy and in the stock market, but overall, if you make the right decisions with the right process, you can do very, very well. And that's what's key here. So just to let you guys know, I'm very active on the Twitter machine. I'm very active on Twitter, and I talk about a lot of these ideas on here, and I engage with a lot of people. So Mo, your buddy, Trump, criticized government debt until he became president of the United States. Then what'd he do?
Then he just printed and printed and printed and did what they all do.
They all do. So guys, the reason I laugh about this is these can become very political conversations, and I am libertarian. I believe in smaller government, but I'm not the extreme libertarian of no government. When debt gets very, very high, we're relying more and more on government because we have to bail ourselves out at some point. So what I did was I went to the internet, the St. Louis Fed website. It's a great website for data, and our software actually, we'll be getting a data feed from there very soon to get a lot of new data from all these public sources and put it into one location right here. So check out our software, everythingmoney.com. It's only $1 a day. So what I did was I pulled the data. I pulled up interest costs back to 1940. So what's the interest that the government paid every year? And then what was the total amount of debt at the end of that year? Because I want to see an average interest rate paid, right? It makes sense. If you pay $1 in interest and you have $10 in debt, what's your overall interest rate?
10%.
10%. So interest paid last year was $475 billion, and on September 30th, and we had $30.8 trillion at that point. That's an average interest of 1.54. And guys, if you look at this, look at where the average interest went. It's been since 2014, it's been pretty low, but now it's starting to go up a little bit. Why?
Raising Fed funds rate.
Raising the rates. And I'm quite sure that when we look at this interest rate today, for July or whatever, when this ends in September, when we see this, my guess is this will be a lot higher number.
Yeah.
Because I think I read the average maturity on debt out there with the US government is about 5 or 6 years. So what that means is they can issue 30-day T-bills, 90-day, 6-month, a year, 3 years, 5 years, 10 years, 30. The average of all of them is about 5 or 6 years, the weighted average. So when you look at the average, what's the 5-year interest rate right now, Mo?
Let me look.
Because when I'm looking at the average term being 5 years, as 5 years goes on, that's a very short time frame. What's the 5-year right now?
4% on the nose.
4%. So if all of a sudden today, all the debt, the average was 5 years debt, went to that 5-year rate, this 1.54 would become 4%. That means this $475 billion would become over $1 trillion. Over $1 trillion. Now, that's not going to happen today. But if rates stay the same for the next 5 years, that will happen. That will end up becoming part of the situation. So you sit there and say, well, how do we pay for that? And that's what we're trying to figure out here. How do we pay for all of these things? Mo, how do we pay for these things?
Print it.
Well, then that increases this number right here. Look at the debt, how much it's gone up.
It's unbelievable.
We went from 20 trillion in 2017 to 31. Right now it's a little over 32.
Yeah, it's about 32 and a half right now. 32.54 is what the government website says.
So how do you pay for these things? You raise taxes or you cut spending. What's more likely to happen in the government? I don't care what side of the aisle you're on.
Raise taxes.
You're not cutting spending, unfortunately.
Nope.
There needs to be.
Their platform will be, we're going to cut spending.
Correct.
But they're not going to do it.
So back to this. The interesting part for me, Mo, was going back in time. I was actually surprised to the 60s and 70s how low the average rate was. Now, I don't know the maturity level, the maturity time frame on these. But look, from 1960 was 2.39 to 1975 was 4.29. It's a big increase. And what happened in there? Inflation started to kick up, rates started to go higher. That's the part that concerns me. But again, I don't know the maturity length at this point. Because if it was a lot of long-term debt here, it's going to skew the number up, right? Yeah. Think about it this way. I want to explain that. If you have $100 in debt and $50 of it is 1 year paying 4%, and $50 of it is 30 years paying 6%, your average is 5% still. Half at 4, half at 5. Half at 6, which is 5%. Now, what if suddenly this was $20 at 1 year at 4% and $80 at 6%? So now it's 20% at 4% is 0.8% plus 80% of 6.8 is 4.8. It becomes 5.6% is the average then. So as you get more to the higher interest rate side, it is going to go and skew this. So maybe they had a lot more short-term debt here and it went longer. I don't know. I don't have that data to see that. So that is something that would be interesting to understand. But guys, the one thing we can't get past is this number and the fact that it just keeps growing and growing.
And there's literally no end in sight.
There's no end in sight. You know, a lot of people out there talk about deficit spending and it's okay. And they say, oh, well, you know, I think it was John Maynard Keynes said like, oh, deficit spending is okay. But people forget he believed in surpluses along the way, and you store your surpluses. You have surpluses when times are good. And when times are bad, you take those surpluses and you pay them out to rejuvenate the economy. But we're not doing that right now. In the last 43 years, we've had 2 years of surplus. And that was a combination of GDP, immense GDP growth in the late 90s. That was just absolutely insane because of technology and higher taxes. And that's just the way it is. Guys, you can't, it's just math. At some point, you have to expect higher taxes as this gets higher and higher and this goes higher and higher. They're going to have to pay for this somehow. So what does that mean about the future? Well, it means we're going to be stuck with, if we have to pay more in taxes in the future, that's less money for you to do things with your family, to reinvest in yourself, and you're giving more money to a less efficient organization called the US government. So I look at this saying, we're taking away and we're going to give more and more money to the government. And guess what? Just like student debt. Oh, go to college. It's great investment. And now all of a sudden it's not that. At some point, we're going to sit there and we're going to have a come to Jesus moment as this debt goes higher and higher and say, whoops, maybe this deficit spending wasn't such a good idea. At some point, it's going to be a little too hard to handle. When? I have no idea. But think about it this way. If you have a credit card, if you use a credit card to pay your mortgage payment, you can get away with it for a while, but eventually you will not have enough credit card limit. Eventually, people will stop giving you money. And that's the key there. That's what I want everybody to understand. I'm just sitting there saying this is not sustainable, even though we've been getting away with it for a very, very long time. At some point, now, if our GDP grows faster than our debt level grows, we're Gucci, man. We're Gucci. We're fine. That debt level will go lower and lower. However, I would argue that it's probably not the case. Look at our debt levels here. Our debt level in 2000 was 5.6 trillion. We're now at 32. That's more than 5 times more, almost 6 times more. Actually, it is 6 times more. It's a little bit under 6 times more. Now let's go and see what the GDP was. What's current GDP?
26.24 trillion here.
Okay, so 26.5 trillion. Yep. So 26.5 trillion divided by 6. Was GDP 4.4 trillion in 2000? So what was GDP in 2000? 10.25. So GDP has gone up 2.5 times and debt's gone up 6 times. That's a problem. That's absolutely a problem. And that's my concern here, guys. So I do think that people have to get ready for slower growth, because whenever you borrow money, you're taking away from future. When we borrow money, we're taking away from future growth. And 2, higher taxes. That's just the way it's going to be. So guys, again, follow me on Twitter. I get very engaged in these conversations. I just look at it as this is just math. At some point, it's got to be paid somehow. and we have a declining population growth. The growth of the population is going like this right now. It's still growing, but not at the rate it was before. So I look at these things saying all these work together to provide something. So guys, subscribe to the channel, follow me on Twitter. I appreciate your time. Take care.